So a typical 3-year cap at 3% cost $98,000. This is for a $100 million loan. It cost $98,000 in 2019. To buy that, to buy that same cap today, costs $3.4 million.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is James Gosse. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is James Gosse. James is Executive Managing Director of Transaction Services at NXT CRE. NXT CRE supports commercial real estate lenders find properties for their exiting borrowers that match their exiting 1031 needs. And in just a minute, we're going to speak with James about how the price of interest rate caps is making it near impossible for borrowers to use floating rate debt. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, James Gosse. Welcome to CREPN Radio.
Thank you, Darren. Nice to be here with you.
Well, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I've been in commercial real estate since I graduated college a while back now, over 20 years. And I've been on really all of sides of the transaction, right? So I learned the business on the buy side as a principal, and then certainly had involvement on the sell side. I was at the Carlton Group for 10 years, really kind of doing that intermediary role. And most recently, the more recent thing was I was at 10X running the institutional group. And then I was a founder of OakX, which is a marketplace. But now I'm running, as Darren, you relayed, I'm running the transaction services for NXT CRE, and look forward to the discussion.
Awesome. So I think the ideal place to start is if you could describe what NXT CRE is and how it works.
Sure. So NXT CRE, we are a platform that effectively what we do is provide, I think you touched on it, but we provide to our lender partners, we're able to generate not must-buy investors, we call them, right? I mean, effectively, these are 1031 investors who are looking to reinvest their cash, and they're identified and sent to us by our lenders. And so by the time they get to our platform, these are, we call them verified, whatever you call it. They're must-buy investors. That's why we call them MBIs. They have a certain timeline, typically 45 days to identify, and then there's a bit more time afterwards to close. But that identification process it happens quickly. And so what we do is onboard them. Once their lender sends them to us, they have a specific criteria. I would like multifamily in Los Angeles or retail in Ohio, whatever it may be. And then we'll work with them to match. Our system has a pretty intense algorithm that matches sort of the first cut of assets. But it usually just starts there, because the reality is once you've matched someone's assets, you need to then take that next step, and sort of listen to what they're saying. I like these 5 out of the 30. Let's go, further that. So we help them find assets and, meet their reinvestment needs.
Got it. So the platform, and help me make sure I understand this right.
Mhm.
So you guys receive the borrower information from the lenders who have these loans with they placed loans already in a property with their borrower. The
Mhm.
terms of the loan are coming up, or is it a matter of just the borrower is just expecting to exit regardless of the terms of the loan?
Darren, you're asking good questions. I like it. Um, it's both, right? So there's the maturity notice, if you want to call it that. So someone effectively is coming down the pike. They've had a loan for 10 years or whatever it might be, a fixed rate loan. Yes, if the loan is coming due, they're going to get notified for that reason, right? That they'll be onboarded for that reason. But typically, if that's the case, they're already planning to do something. People don't typically let these loans just expire without a plan. So it's really more the other one. It's more, these are people that maybe in year 7, 8, 9, 10 of this time frame of their loan, but they've made a decision to sell. Right, that decision happens before we're involved, before their lender's involved. I mean, that's owners are making these decisions every day. So once they make that decision to sell, as is required by loan documents, you may be familiar. You often have to give them when you have a payoff request to pay down your loan. You need to give them at least 30 days. So the lenders get an additional 30 days, sort of heads up, if you want to call it that, and that kind of makes it so we're able to have a 75-day window instead of a 45-day window, right? So, that's kind of the crux of it.
Got it. So it's a payoff request. It's kind of the cue to onboard.
That's what was sort of an early warning signal, as we see it, and that's sort of the value in our partnerships with our lenders. Is obviously they want to know what's going on and help that borrower, find a new property and then make the loan on that new property. That's what their skin in the game. That's what their interest is. But it lines up well with what we want to do and ultimately what their borrower wants to do. So.
Got it. And I guess that was what I was trying to figure out is like, is this just you have the whole portfolio of loans in your system and you're, looking for activity, or is this like we're getting close to, but this is that request is where it's actually generating the I guess the onboard.
So we don't know exactly how many or are coming from who and when, just that they're coming, right? If that makes sense. And there's sort of an ongoing flow of these, and we again, some of it's maturity driven, but it's very rare you find one lender that has a bunch of loans all maturing at the same time. They try to spread them out.
Gotcha. So, and then from there, you're basically following the 1031 guidelines. Was it 45 days to identify? And I mean, so you're getting the cue that they're going to sell, which then gives you the bank. When you said 30 days, they have to at least 30 days notice. Mm-hmm. So you've got 30 days plus the 45 days. Right. That's a minimum amount of time.
Right. Yeah. So we're able to communicate then with, the borrower is able to, the lender is able to communicate with their borrower and say, look, are you planning to reinvest? If they are, great. You can go, fill out this questionnaire and go look at some opportunities on NXT CRE. And if not, or if they're not planning to, obviously they don't come to our site. Right. I think it's certainly, we have the right incentives, if that makes sense.
Got it. Now, the next property, are you involved at all, or do you have a portfolio of listings that are available, or is it more of just the communication with the borrower that they do intend to, reinvest, and that's kind of queuing it up for your lending client, who's actually, if I understand right, the lender is your true client, because that's the one that you're trying to get them the next loan, or get the borrower to use that lender again for their next loan. Is that my understanding that right?
Yes, a little bit. I'll clarify. I mean, the lender the benefit for the lender, and one of the reasons we talk about this sometimes, is the digital line of sight, right? So most lenders, when they make a loan, they'll make that loan, and then they may hear back from the borrower, they may not, right? I mean, the reality is you may hear from them, you may not, you may get a payoff request. I mean, typically that's something they have to do by the documents, but you may have, my point is, you may hear back from them and have a sort of rapport, and you may not. So the point is once that borrower says, I'm, great, I'm selling my property, as by asking for this loan payoff request, that's kind of them telling you that I'm selling this property. Well, it kind of alerts that lender, I'm about to lose a loan, right? Again, not lose a loan, but you want to retain that borrower if you can. That's the name of the game for all lenders. So from that perspective, yes, we're trying to help them. Ultimately, that's where their head is at. That's where the skin is in the game for them, because they ultimately want to be in a position to help that borrower again, right? So from the other side of the coin, I think you said you matching or just helping direct. No. Once they get here, it's a fully curated list, right? We are not a marketplace. We're not a listing site. So when someone goes on our website, let's say, John Broker goes on our website and uploads 50 properties. That's fantastic. Now you go on our website and go, I can't find any of these properties, James. That's because no one can. By design, if you upload a property, so there are a lot of properties uploaded, but people can't see them except when they are matched. So once you're matched, and again, this is the idea behind keeping some of this stuff anonymous. We found a lot of our institutional clients like it because they can market assets without marketing assets, right? They can sort of get price discovery without having to commit to the market and say, I'm definitely going to do this kind of thing. But it lets us then have a wide swath of properties to which we can match. I mean, we're able to match them with properties that are on the market. We can match them with off-market properties. And so it's been, we've gotten a very, dare I say, rave reviews so far from the MBIs, because ultimately it's not just what we do in the initial match, it's then the follow-up, right? Someone may say, great, you sent me 83 properties, but I'm not really that interested in 75 of them. These 5 are interesting, and here's why. I mean, the 5 is interesting is great. The here's why is more important. If I like them because they all have $20,000 a month in income, which I need to support this new loan, or they're, none of them are more than 10 units if they're multifamily, because, I want it to be enough that it's, that it can generate the income, but not so much that it, I don't want 30 units because that becomes a headache, right? So, but I don't want 2 units either, because that means that if I lose one tenant, I'm at 50% occupancy, right? So it's kind of like,
right.
Finding things that make sense. And what we've found is that they really, ultimately, these investors, by the way, the 1031 buyers, these are very sophisticated investors, right? It's not like you're dealing with someone that you have to explain, well, this is how a cap rate works. I mean, these guys know exactly what they want. So working with them, obviously it makes our job easier, but ultimately our job is to bring them as many suitable replacement properties as we can. They then have to pair through those and say, these are the ones we like. But ultimately, we look at our job as being successfully completed with that MBI. Once we've, identified a match that they say, yes, I am moving forward. And this kind of goes back to something you said earlier. It's not just the 45 days. When you say 45 days for identifying, and we can extend that, as I said, to 75 when we get the loan payoff request comes in early enough. But it's 45 days is a little bit, it's a misnomer, because it's not like you just need to identify something in 45 days. You have to find it. You have to do the due diligence, and you have to tie it up, right? I mean, that's a very different than, hey, do you have 4 properties you might buy? Because anyone can do that, but that doesn't actually accomplish what you need, right? Because you have to then say, I have identified XYZ property. And so to be able to say I've identified it, you really at least need to have had, that contract discussion. You want to have the thing tied up so that now it's just a closing function. So what we've found is that the buyers, the MBIs, these guys are extremely motivated. They don't let the paint dry on anything. they're asking for information, right? I mean, we tried to explain this we did a CCIM webinar yesterday. I was trying to explain it to some of the brokerage community. By the time they're matched to a broker and to a seller saying, hey, you're one of 5 people that this MBI is interested in their asset, you're already 3/4 of the way down the sales funnel, right? I mean, they've already said no to 75 other deals. They've probably, gone through your materials, and at that point they just have questions and want to talk about price, right? Because they don't have time to play around. They need to get into due diligence and get the process going.
Yeah, and
Sorry to
having
give you a
done
long answer, but
no, having done a couple of exchanges, I mean that 45 days is fast, and I
includes
would
weekends.
think that. Oh yeah, no, I would think that this must buy investor would welcome the kind of the narrowed funnel of the opportunities that kind of match their criteria.
Otherwise, it's really hard for them to sort through all this stuff.
Oh yeah, I mean you're literally going. I remember a guy saying it's kind of like standing at the ocean with a Dixie cup, saying, go ahead and empty the ocean. And it's like there's just so much information, and just you can try and narrow it, but there's still to have kind of more of a systematic way to find a replacement property. I didn't. I mean, I knew about the matching thing from the lender thing, or I understood that, and in this piece, I guess I kind of knew, but to me, it's making a lot more clear on the value of that for the borrower, the investor that's doing the exchange, just to have that. And let me ask you, so your CCIM group that you were working with yesterday, is being well received in the broker community?
Unbelievably. I mean, I've got to give a big thank you and shout out to CCIM. We joined the Member Advantage program, I think it was May or June of this year. And CCIM has been fantastic. I mean, as you being in, a broker of any sort, right, insurance or what have you, you can certainly appreciate CCIM and sort of the way they have the education system. I mean, they're looked at certainly in the brokerage community as, this kind of the leaders, at least on the, in terms of knowledge base and those kind of things. Now, granted, are there other brokers that are not CCIMs that have done huge volumes? Of course. That said, we love CCIM because I feel like they take the time, they listen. We were on that, we had a webinar we'd scheduled for them, right? Kind of just talking about us and our services. And we had, almost 260 people sign up for the thing. And it, we had, it went out once because we had too many people in the first call. So it's been very well received. I think, Darren, it kind of goes to the point. I mean, think about the discussion we're having here today. And you said, I know a bit about you, but, as you're making it clear, as the light bulbs go on, you can see what the value is, right? So yes, there've been instances where I'm having to talk to, so-and-so at, a brokerage firm and explain to them, understand that and basically make the light bulb go on for them. Because once they realize, you have someone that's interested in one of my assets, this person's already qualified, doesn't need to do the proof of funds, doesn't need to do a lot of this, has a loan, right? Has a lender that wants to lend. And,
those are 2 big pieces right there,
right?
Or 3. You have somebody that wants to make the deal. You've got they've got the capital, and you have the lender. Everybody's green light. Those are 3. Right. Those are big pieces to a right. deal.
I mean, those are the important components. And so when you have those, you can sort of see the light bulbs go on, and people understand as well. I mean, with all respect to all of our MBIs, because we love them all, I think they would be the first to tell you, they can be a little bit less price sensitive than a typical investor, right? I mean, Darren, if you and I were going to go buy a multifamily property and we said, let's find a deal that really is juicy and is great, and I send you 3 or 4 deals and you send me a couple, we go down, we're going to be bargain hunting, right? We're going to be beating up the sellers, trying to get the best price we can get. And that's great. We're probably going to make a great deal. The reality is yes, these are still savvy investors. They still want to make a good deal, but they're not going to go to the level of brain damage that you and I will, right? Only because they don't have the time. They just don't have they can't play around. They can't waste 2 weeks negotiating.
Right. No, that's definitely a critical piece to this, and I appreciate you clarifying for me that piece, because like I said, I did understand the front end working with the lender and the borrower thing, but the value of the portfolio of opportunities, and the way that the borrower can't see them until they are
Matched.
enrolled,
Exactly.
or they've answered the questions or whatever, to quantify, or they're not going to see the whole A to Z. They're going to see the portion of that fits their exchange. Correct?
Only that, right? Exactly.
Yeah.
So, and then they're going to sort of self-select the ones that they like versus the ones they don't, and it kind of that starts the second search, if you will. And
Got it.
ultimately, we try to have conversations, as many as we can, with these buyers as they're coming on, because oftentimes they'll tell you stuff that you can't put on a questionnaire, right? Like, yes, I put down Los Angeles County multifamily, but what I really meant was Studio City, right? I mean, it's a big difference between,
Yeah. Right.
well, geez, okay, so it's not 100 properties we should show you, it's 20. But
Right.
that's actually helpful, because now all 20 are in, guess what, Studio City, right? So it just depends on, there's something to be said. The relational part of it is certainly interesting and important as well.
That's good. So let's talk just a little bit here about interest rate caps.
Oh yes, fun topic.
The topic we started with.
Yeah.
So describe for the listeners what they are, and who uses the interest rate caps.
Well, interest rate caps, for those that don't know, and it's to me, I mean, this is not something that they teach you in business 101 or anything like that. This is a little bit of an obscure product, like interest rate swaps. Interest rate caps are used by owners of and buyers of property, and they can either be required or they can be elective. So you can choose to get this if it helps you sleep well at night, or it can be required in many cases. I know that Freddie Mac will require them for any floating rate loan. And again, it's just a risk mitigator. So what is it? Let me start with that. An interest rate cap, again, for floating rate debt, it basically limits the amount of differential, we'll call it, that you can have. So if I have a 3%, if I have a 3% floating rate debt deal with a spread of whatever it might be, 200 or 150, means that if I buy an interest rate cap with a strike of 3, means that anything above 3, I'm not going to have to pay for, if that makes sense. I basically have capped my interest cost for a set period of time. Now, there's a few things that make it up. I'll just run through this quickly. There's the notional, which is the size of the cap, right? So it makes a difference if I buy a cap, obviously, for a $50 million loan or a $100 million loan, but it's kind of linear, except on the extremes, right? So typically, a $100 million interest rate cap is about double a $50 million interest. Again, all else being equal. So that's typically the rules, except on the extremes. So that's one component that's kind of built into it. Then there's the term. Obviously, if you want the longer the term, the more expensive it's going to be. And then the third is the strike rate. So you sort of have the rate at which, above which the cap kicks in. And I mentioned that one before. Hey, it's 3. Well, let's talk about today's interest rates, right? 5, 5.5. So if you bought an interest rate cap at 5.5, if the rate went to 6, you're still paying 5.5, if that makes sense. And again, these are floating rates at debt, so I'm using I'm using exact numbers, but roughly speaking. So what that means is, the lower the strike rate, then the higher the cap price is. Typically, these things are typically bought and prepaid at one time, right? So at the beginning of a loan, they'll typically do it, and in some cases, and we've seen this recently, Darren, I think this is why it's pertinent, that some of these floating rate debt deals that are coming due, because I mean, oftentimes these are used when you are doing a bridge loan or things like that, where you're just it's a transitional situation, or you're stabilizing a property. We've seen where these caps are. I mean, literally, it used to cost 98,000 or something for a property. I was looking at an example I did before. Yeah, so a typical 3-year cap at 3% cost $98,000. This is for $100 million loan. It cost $98,000 in 2019. To buy
Done.
that, to
Yeah,
pay
buy
that
two.
same,
Yeah.
to buy that same cap today costs 3.4 million.
Yeah.
Right. So it's not only not affordable, it basically has put the heavy brakes on that market in terms of what's doable. Ironically, this kind of goes back to what you mentioned before, Darren, which is, people are still moving forward. So yes, they need to adjust to the new normal, but I mean, I think that's the reality is we're still in an interest rate environment that's very reasonable on a historic basis, right? If you look at historic levels, I mean, in 1980 we were at 15%, so this is not crazy by any stretch.
Reasonable on a historic basis, but shocking compared to a recent
No
historical, basis. And as we were talking before we started recording about, the market goes forward just like the sun comes up every day and sets every night. It's going to go on with or without you. But for the rate cap, I would guess that this is more of a situation where there's those that purchased them previously and they're getting ready to expire, and their financing is coming due for either balloon payment or refinance, which sounds like it might be a good cue for next CRE.
Right.
But
and it's interesting you say that, because I'll give you an example. We actually have a real life example. Sorry, that we saw recently, and I'll leave the names and all that stuff out so that it doesn't identify anyone. But we've been seeing, ironically, we had a large 1031 replacement need. It was over 100 million actually of equity, and so the deals that we came across were sporadic in terms of we're having to look at different markets. But ultimately, some of the deals that the system matched to, there was a couple where, I mean, these are beautiful Class A or double A in some cases, multifamily built in the last 2-3 years. But again, some of these were built, like, again, think about it. If you built something in 2020 or 21, you probably weren't putting on long-term debt, right? You were putting on short-term debt to get it stabilized, and then you go get the long-term debt, right? So what we're finding now is that we have one case where it was north of $100 million loan in place, and it's a floater, right? So there are extension options, but the extension option includes, guess what? You have to buy an interest rate cap, and something that I believe, I don't want to misquote what it was on this one, but I mean, it was somewhere in the neighborhood of $7-8 million for an interest rate cap. And when you think, well, geez, okay, yes, it's a large deal. Well, but if you're buying these deals with $20-30 million of equity, then $8 million of equity just to continue to hold it exactly like it is, nothing's changed. That's sometimes a tough pill to swallow, right? I mean, we're seeing Brookfield, and we've seen a lot of the big owners around the country as well start giving the keys back on deals like this, right? Saying, look, we're not going to go and buy the interest rate cap because we can't, and we can't continue to have the loan if we don't buy the cap. So here you go, lender, you figure it out, right? And I mean, the reality is most of these lenders are going, no, slow down. Let's work on something, right? Because they don't want to be stuck having to sort these things out by themselves.
Truly, the example of if you have a $5 million loan, that's a you problem. If you have a $500 million loan, that's a bank problem, kind of thing. There's definitely
exactly right.
Yeah.
You get to some level, then all of a sudden, you're exactly right. I mean, they would take your $5 million loan back, no questions asked, and foreclose and go figure out a way to sell it. You could try to give them a $500 million loan back, they're going, well, hold on.
Yeah.
Right.
Yeah.
They want your expertise involved still.
Yeah. That's and I'm guessing that those larger ones with institutional borrowers and that there's a little bit more flexibility to work out that kind of thing, as opposed to the mom and pop or individual investor that's got a smaller property that
I
you
would
know
say that is the case by and large, Darren. But I on the flip side, remember, I mean, this is not like 2008 or more recent periods of pain or tightness, if we want to call it that, in the credit markets. So these extensions, we're seeing them done, but we're seeing them being done very selectively and situationally. So 6 to 12 month extensions we're seeing instead of the typical 1 and 2 year. And again, why? Because I may be let's say you're a life company and I'm one of your fantastic relationship borrowers who you've done business with for. Yes, you're going to do everything you can to help me continue to do it. But guess what? I probably, if I'm a life company borrower, I probably only borrowed 60% anyway, right? Because that's what you guys lend. So this really speaks more to the banks, CMBS, the high leverage borrowers, right? Where there's less space in the deal for any blips. They're more
right.
sort of financially structured. But by and large, yes, the big guys tend to get favoritism, or whatever you want to call it. They tend to have more options to them. And again, oftentimes these institutions have, we know this, as you probably do as well. They've got opportunity funds. So oftentimes they have lending capabilities through those funds that typically they'll go in and lend, aggressively. But they've already sort of thought this through. They've seen this before, so they have gap funds that are sort of ready to go. So they may be able to delay their own pain, if that makes sense, or delay the situation. And I say pain, it's not really pain. They may just be able to delay the situation, because right now that's really what most borrowers want and need is, I just need some time. There's nothing wrong with my asset, but the market, don't make me sell into this market. Right? Where
Right.
people can't
Right.
get new financing to buy the loan, or there's so few deals that have gone on. And then what we're going to see at the end of this year is the opposite. We're going to see everything coming to market, but the bid ask spread still has to come in a little bit, right? I mean, there's still a gap between what people think their assets worth and what someone can pay based on, and a lot of it's based on financing. If I'm out there today trying to get a loan, I used to be able to get 70, 80% leverage. I can probably get 50,
Right.
right? Just based on loan sizing. So it's making it harder to do deals. But again, that's a function of, that's somewhat driven by the pricing. As that adjusts, we'll see the market go back much more normal. I mean, you're exactly right. The people that want to do business are going to do business. There's going to be people that sit on the sidelines and kind of go, "Oh, I miss the cheap capital," but it's gone. Everyone's on the same playing field.
Right. Right. No, I get the that it's going to go on, and I think the hard part for, I think, most people, myself definitely included, is the reset of the mind to what the market is, as opposed to what it was, based on the numbers that I entered the market on when I thought everything worked, and accepting that either now the values decreased, or the loan cost has increased, or everything's changed, and my number, the only one that's not working as well is I'm not benefiting like I originally thought I was going to, because of all the reset in the numbers. And for the short term that may be true, but I was talking with somebody earlier this morning just about it's more of a long horizon kind of thing. If you're able to have a longer horizon, uh
Right.
you can get through these things. But if you have loan maturity issues, and you're forced to sell or make a deal or refinance or whatever, then you're going to have to come to the reality sooner.
But many, like, I mean, again, many of the, think about if you'd bought something a few years ago and you bought it based on, hey, I think we're getting a deal. We're buying this at a 7 cap in a 6 cap market, right? And today you're looking at it and say, well, we're sort of bearing down on this loan maturity, and I think I'm going to sell. yes, it might be painful as you get out into the market and realize I'm actually going to have to sell it at a 7 cap or a 7.5 cap. So now I'm not, instead of having equity and making money in this deal, I'm just going to have the cash flow that I got along the way and the pay down of debt and all that kind of stuff. And, but here's the silver lining to that is, yes, but now when you go to buy, you're going to get that deal on the going back in. Right. So
right. It's
that's
on
the
both
long
sides.
look.
Yeah.
That's the long horizon mentality to it. And again, all investors, well, most of the investors we've dealt with, they may look at, individual deals on a, timing and situation, but everything they're doing is on a long-term horizon. So, I mean, that's the flip side.
So I think it was before we started recording, you'd mentioned kind of the activity in the market quarter to quarter. Can you speak a little bit to what you're seeing in the market as far as activity?
Yeah, I mean, I think we're probably seeing much of what others have been seeing as well. There, at least from a investment sales perspective, we've seen it's I don't want to say it's come to a grinding halt, but it's been pretty close, right? The first half of this year has been pretty lackluster in terms of what everyone had hoped for, but it's really because, and again, that kind of comes off last year as well. We weren't exactly going gangbusters last year in terms of volumes, but volumes just dropped off a cliff the first half of this year. But it's mostly, again, in our opinion, it's mostly uncertainty, right? The uncertainty where interest rates going to go, how are they going to go up to 8? So once we kind of got to June, around that time period, and started to get some clarity on, okay, interest rates, we may end up at 5.5%, 6%, but that's going to be it, right? That's kind of the end of it, at least in the short run. And then investors start to reset. So what we've been seeing now, at the beginning of, end of June and beginning of July, we've seen a huge volume of deals coming to the market. And and the reason I mentioned when is, if these deals were all trickling in, April, May, June, it means less. It's the fact that these deals are coming in July after the market has now said, okay, here's some certainty for you, right? And so these deals are now coming out. And I mention that because it's not just deals are available. These are deals with, obviously not in every case, but a lot of realistic sellers, right? If someone is bringing an asset to market now, they, if you think about it, Darren, why would you sell an asset you have right now unless you have to, right? So right. You wouldn't is the answer. So, these are motivated sellers that realize they have to do something, and they're trying to not be the last guy to figure it out. But we're expecting, that the volume is going to continue in terms of new deals coming to market and listings available. I think we're not going to see as much activity as we'd like, just from a macro standpoint in the third quarter, because we're still trying to find that bid ask, that sort of happy place, right? And right now there's still that gap between the bid ask spread. But as you've seen, and I've seen previously, investors are pretty savvy. And so it may take, a couple of months, but it won't take a couple of years, right? That is the point. Investors don't like to lose when they're bidding on deals. So they'll quickly become accustomed to the new normals. And, hey, if I don't like it, I don't have to play. Certainly is the case. But we're expecting the fourth quarter of this year, as, some of these extensions are burning off now, as we've talked about. Lenders are having to be very selective about where they choose, because it's not like I have cheap capital and I'm just withholding it from you if I'm a lender, right? I don't have access to it. So it's not even an option. They're only able to, that's why they're doing shorter extensions, right? They, to the extent we can manage that, we want to start making higher interest loans. So, we have to, that's what we do. So,
yeah, no, I mean, and they're kind of in the same position. Their cost of capital has increased, so they've got to lend it out at a higher rate, and they still want to make money. And
good lenders, they want to loan money, right? I mean, this is,
yeah.
So
if everybody sells and nobody buys, that's that's not exactly. I mean, that couldn't couldn't work,
doesn't work.
period, because
No,
you
you need
gotta,
to have
there's
a
a sell and a
balance of.
buy, there's two people involved there. So, but no, it's interesting. Well, I do believe that, or I hope, let me ask it this way. Everything we've talked about, kind of and especially this activity you've seen in the second quarter, and as you kind of indicated, the fourth quarter, you expect more activity. Do you sense that, are there any more potential surprises, or do you feel like we have reached or are about to reach what the equilibrium, or what the market is, and that's where people are getting comfortable again, like you said, realistic sellers on the valuations? Is this kind of reassurance to investors and buyers and sellers that this is the market and we can go forward?
I think so. I mean, I think that's one of the reasons the Fed. I mean, obviously they're speaking to a lot of constituents, but Jerome Powell, specifically mentioned commercial real estate because, again, I think they're aware of what's going on. I mean, you're exactly right. Lenders want to lend money. They're certainly trying to adjust to the new norms. Our expectation is that once this uncertainty was removed, and again, it'll be completely removed when we get to that last rate cut or rate increase, excuse me. I guess the surprises could be if they didn't raise the rates at all more, right? I mean, we're expecting 2 more 25 basis increases now, or they were just to do one of them. Theoretically, if they decided that things were going so well, they were going to do a rate cut. I don't think that's very possible, but I guess anything's possible. So other things, I think that's what you're getting at. Other things affecting this, or what else can happen that would sort of change things or shake the market? Obviously, there's geopolitical things, but to some extent, that's even been baked out of it, right? I mean, we've been living in sort of this new normal where all the markets are connected and tied together. Not just economic, but political and all this kind of weird stuff. So I think to some degree, a lot of that's already been baked in. That said, obviously there's a handful of things that could play a role and could change the direction of or trajectory of kind of the pullout. But I don't think what we have here, I mean, I almost said recovery, but the word isn't recovery, because if you think about it, this is not like 2008. It's not like these prior ones where, properties are sucking wind and, things are really struggling. Everyone's property is now worth less, kind of thing. The reality is you've got a lot of properties that are chugging along, are doing exactly as they're supposed to. I mean, that's the tough part. Is you have some owners that have done exactly what they're supposed to do, but they finance the deal with 3% leverage. So now when they go out and try to refinance at 5.5, their loan no longer meets that 1.25 coverage ratio.
Right. No, I get it. Hey, James, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, then we look to see if we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, the Fed, political, supply chain, whatever you believe or you identify as the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer.
Right.
And so if you're willing, I'd like to ask you, James Gosse, what is the biggest risk?
Well, a great question. And certainly, the topic we were just touching on, by the way, Darren, I think, oftentimes, so people are aware, interest rate caps are often referred to as insurance policies. for your interest rate. So I just found that an interesting aside. The biggest risk for us, and this is a good question, it's one of the things that, if I'm honest, sort of this probably keeps me up at night more than other things. It's, it's not making people aware of who we are. It's not being able to get our message out to the right people, right? That's the risk I see. And again, we're obviously doing what we can to eliminate, mitigate, minimize all that kind of stuff. That said, to us, that's the biggest risk. Obviously, there's other market forces and things like that, but just from what we can control, to me, that's the biggest risk, is we have something that when we explain it correctly, and when we have the right people we're talking to, light bulbs go on. And I mean, when we have the discussion with lender partners, they go, of course we want to do this with you, right? Of course we'd like. So, but it's just a function of, the risk is that we don't communicate it right, or the risk is that we don't communicate it to the right audience, or, whatever the case. So to us, it's an exposure. And again, I see this very much so. We've got the guy, I think the gentleman who set me up with this, Tim, is outstanding. And he spends all of his time trying to figure out, how do we make sure the market is aware of us, has the right perception. And again, that's one of the reasons we were so pleased to join CCIM, their member advantage program. Again, for us, it's I would say an exposure, or, making sure we get enough exposure is our biggest risk.
No, that's well said. If you have the solution and nobody knows you, that's not a good recipe for success.
Well, and history is littered with with people that had a fantastic product and couldn't communicate it. So we're making sure we try to communicate.
Well, I get it. James, where can listeners go if they'd like to learn more, connect with you?
Yes, obviously you can start at our website. It's nxtcre.com. If anyone has questions or would like to talk to me, I'll just give them my email here as well. It's james@nxtcre.com. Certainly you can if you want to follow us on LinkedIn, that's a good way to keep up with our newsletter. We posted that webinar. I think the recording is going to be posted to that here this week sometime. So lots of information out there, but certainly nextcre.com, nxtcre.com would be the place to start. And yeah.
Got it. Well, James Gosse, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Indeed.
All right.
Thanks, Darren.
You got it. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.